Hello, wonderful people, and welcome back. We are now on video 3 for chapter 9, still monopolies. Now, if you remember, perfect competition is a price taker, but monopolies are price setters or price searchers. And that is true of oligopolies and monopolistically competitive firms that we're going to go over in chapter 10. So basically, of the 4 market structures, only one is a price taker, and that's perfect competition. The other 3 look like this. They are price searchers. Now, a little bit of a reminder. Price takers, they produce what? Identical products. Remember, they're homogeneous, and the reason we have wheat, corn, soybeans is like all wholesale. The firms are small relative to the market. This is why there are many of them. Price searchers. Firms produce products that differ, right? They are slightly differentiated. In this case, they are unique. They're so differentiated, they're very differentiated because this is a monopoly. The amount that the price searcher firm is able to sell is inversely related to the price it charges, meaning if they want to sell more, they have to apply the law of demand and they have to go ahead and put their products on sale. So it's very important for them to reduce their costs in order to actually be more competitive because they do have control over price. Now, in the case of a monopoly, that's not the case because they are a monopoly. However, if they want to prevent someone from coming in and undercutting them, they still have to think as far as, I can charge, but only to the tolerance of the consumer, not charge in, such high amounts that I make it so easy for somebody else to actually compete with me. It's a delicate act. Now, if we were to compare these two, we already went over this. Product lacks uniqueness for price takers, right? There's a lot of competition and the pricing is dictated by the market. If you look at price setters, it's the complete opposite. The product is unusual or it can differentiate itself. In this case, it's unique because it's monopolies. There's way less competition, in this case, none. And the price that the company does have control over prices. So, for instance, latest tech gadgets, specially manufactured machines, original art or jewelry versus commodities, natural resources, generic consumer products and services. You see, one is like flat and indistinguishable and one stands out and has a personality and you can price it differently from the rest. So this is how they compare. So a monopoly is a price searcher, so are oligopolies, so is monopolistic competition, to the exception of perfect competition, which is a price taker, and we compare to it because this is really what we're doing this entire chapter. So let's look at our next point here. Marginal revenue and price. If you recall, when it came to price takers, price equaled marginal revenue. Why? Because the company takes the price from the market, and whether they sell 1 unit or 1,000,000 units, an indefinite amount, they actually are looking at the same price always. So this is the price they sell 1, this is the price they sell 2, this is the price, etc., etc. So if we were going by the same prices over here, and this is our demand curve right here, and we were taking the price, for instance, of $40 right here. Notice the price of 40 is going to change depending on the units. Therefore, you're no longer looking at a horizontal curve. So the demand here is horizontal because you're looking at perfectly elastic demand, and with monopolies or any price searcher. So let's think of them as price taker, price searcher, because there are 3 of them that are price searchers. You're no longer looking at a perfectly elastic demand. You're looking at something like inelastic or elastic demand, mostly in the elastic range. Most companies cannot increase their prices indefinitely, and most companies, if they increase their price, they will see a change in their sales. Therefore, the elasticity of demand is most likely to mean that the sales as a percentage outpaces the price as a percentage. So we're looking at more elastic versus perfectly elastic. Now, look, 2 curves that overlap. One is marginal revenue, one is a demand curve. Here, there are 2. So when you see these descending scissors, think of them as a pair of scissors and they're coming down. And now you are looking at a price searcher and the price exceeds the marginal revenue. And I'm going to show you mathematically why. Again, another simple way of looking at it. However, this is your, right here, demand curve. This is your marginal revenue curve. Yep, I moved the whole thing. And this is your demand curve. And we know this why. We know this because the price is always higher than the marginal revenue. meaning at 6 units, the price is 70, but the marginal revenue is 40. At 10 units, you're looking at 50 for the price, but you are actually looking at almost like nothing for the marginal revenue. And so what we're looking at here is the fact that the marginal revenue is lower than the price. And because it's lower than the price, it's going to actually lie below it. So let me show you this example. So in this example, and this is a price searcher, it's a monopoly in this case, the price should exceed the marginal revenue. We have a price of $10, but I want to show you why the marginal revenue is less than that, and it's $9.25. So we're going to take this example. Imagine you have a price of $10, and at $10, this company can sell 2 units. Their total revenue is $20. Simple. $10 per unit, 2 units, $20. However, this company wants to sell more. 2 is not enough. So they want to see, can they sell 3? Well, they can sell 3 on the condition that they do what? They lower the price because of the law of demand. If you want to attract more in sales, you have to lower the price. So now to sell 3, the company slashes the price down to $9.75. Is this good for them? Well, as far as total revenue, yes, because they went from making $20 in total revenue to making $25, right? $9.75 times 3 is $29.25. So this is a good move. However, what happened to the marginal revenue? The marginal revenue is $9.25. Where did that come from? What was the price? It was $10 right here. How much did the price change by? It changed by a quarter. It went down from 10 to $9.75. For how many units? For 3 units. So this 75 cents here is the 25 cents from the 3 units, because you can't put on the shelf 2 products for 10 and a third one next to it for $9.75 when they are the same product. So if we change the price from 10 to $9.75, we're changing it for all 3. So now you have the price of 10 minus the revenue lost of 75 cents. That gives us a marginal revenue gained. So this is marginal revenue lost. I know it's kind of weird to say it that way, but it is, of 75 cents. This is the marginal revenue gained of $9.25. That means that the price is 10, but the marginal revenue is 9.25. So if we go back here for a minute, this is your marginal revenue. So at any quantity, you will see that the amount here, so like draw a line, let's see if we can go draw. If we were to take a straight line, just to show you, let's say this is 4 units here, right? Here, this is taken from the black curve, that's the marginal revenue curve. This is how much the marginal revenue is, something like $65, and taken from the demand curve, you come over here and find out, oh, this looks like something like $77. So the marginal revenue taken from the marginal curve is like 65, but the price taken from the demand curve is like 77. So the price exceeds the marginal revenue. The price exceeds the marginal revenue. That's what you are looking for here as far as why that's the case. So here again, if we were drawing, if we, had you have marginal revenue, you have demand curve, it would be like this. This is the demand, the one that's above it. This would be the $10. And this right here would be the 9, oh God, and a quarter. I don't know how people maneuver the mouse, right? It would be like that. This is what you would be looking at. And this would be the quantity of 3. Okay, I hope this helped. Let us continue. Well, actually, I'm looking at how many minutes it's been. I'm going to have to go into video 4 in order to go over the rest. I will see you in video 4. Have a good one for now.